On the program today, President Ramaphosa of South Africa says EU's position on vaccine patent waiver has softened. Ethiopia seeks expressions of interest for 40% of state telecom. Tanzania launches a new gold refinery as its central bank plans to start buying the metal to diversify its reserves. All right, let's kick off with Africa trading numbers now. In Africa, it was mostly positive. GSC index traded in the green at intraday, up 0.73%. The NGX index is closed. There's Nigerians commemorate Democracy Day. Elsewhere, EGX 30 was up 0.55%, and Kenya closed 0.09% down on Friday. And the story was different in the Middle East as we saw more greens. In United Arab Emirates, Dubai gained the most at 0.90%, and Abu Dhabi jumped 0.51%. Qatari index added 0.67%, while Saudi Arabia pulled back 0.06%. And European stocks advanced higher to start the week as investors look ahead to the June meeting of the U.S. Federal Reserve. This and more will form our conversation now with Chelsea. Great to have you, Chelsea. Well, this morning after the G7 summit, and China was the focus of the meeting as leaders agreed to set up their own infrastructure aid program to counter China's Belt and Road initiative. What details do we have now?
So this is being called the Build Back the World, or Build Back Better the World, and BB3W. So quite a complicated name, but essentially what this is that G7 leaders would like to offer an infrastructure aid program to lower and middle income countries. They have said they want to ready up hundreds of billions of dollars for this, though it's still unclear where that money would specifically come from. And the goal is going to be particularly projects for climate change, to combat climate change. So we could see them offering funding for things like wind farms in Africa or solar panel projects in Asia. And this is really meant to counter the impact of the Belt and Road initiative from China. China has spent trillions of dollars helping to fund infrastructure projects in many parts of Africa, Asia, also here in Europe and Latin America as well. And there's been a lot of criticism over those projects and how expensive they've been, how much debt countries have had to take on in order to go through with these Chinese projects. And many times those projects seem to be a little bit difficult to finish and become profitable. So the EU wants to, the G7 wants to offer an alternative that they say would be more fair and transparent.
All right, but the European economy is quite dependent on China. Are businesses worried that this will inflame tensions between the two?
Yeah, the rising tensions between Europe, between the West and China is definitely something that is hanging over every business and every investor in Europe. In the past, Europe had been very, very reluctant to criticize China because of how strongly they depend on the Chinese market. Many companies like BMW or Mercedes or Adidas here in Germany, and this is true across Europe, depend very much so on Chinese consumers for growth. That hasn't really changed over the past year. In fact, the Chinese market has only gotten more important for a lot of European companies. But Europe is starting to come out and confront China more, particularly over its treatment of its Muslim minority population, as well as its actions in Hong Kong. And this is something that has brought tensions to the fore. But for now, Europe is trying to really balance its relationship with China and that with the U.S. and other partners, because it still very much needs the Chinese market. And as well as we heard from G7 leaders over the weekend, they also need China on board for things like climate change efforts, because without China, they won't be able to hold to these Paris Climate Agreement efforts to reduce emissions.
And all eyes are on the U.S. Fed. What's in the minds of market players in Europe?
market players are not expecting much of a shock from this meeting. Actually, today the DAX hit a record high here in Frankfurt, so investors are going into this meeting feeling pretty calm about the situation, and that's even despite what we've seen in big changes in the economy over the past couple of months. Particularly, what investors are going to be looking for is how the Fed is looking at the rise in inflation that we've seen in the U.S., but also really across the world. And U.S. inflation is running at its highest rate in 13 years. But what we've heard from Federal Reserve officials is they aren't too worried about this increase. They think it will be temporary, so they likely are going to continue their stimulus to support the economy. But of course, there's a lot of tea leaf reading in any sort of Federal Reserve meeting, so there's going to be a lot of analyzing of anything that the central bank says.
All right, Chelsea, we'll leave it there now. Thank you so much for the updates. And in the UK, businesses are calling on the government to extend emergency COVID-19 support as Boris Johnson prepares to delay the end of lockdown restrictions by up to a month. Let's hear more from Juliana. Great to have you, Juliana. So the Prime Minister is expected to announce a 4-week delay to the final easing of lockdown restrictions in England from the 21st of June. This certainly will have a critical impact on businesses if he does delay the easing.
Well, absolutely. Good afternoon, Laddie. We haven't obviously had a confirmation because the Prime Minister is currently in Brussels attending that one-day NATO summit, but he's expected to fly back pretty swiftly to hold a televised news conference today at 6 p.m. where he is expected to delay Freedom Day, which was supposed to be this time next week, Monday, on June the 21st. And this is all down to the Delta variant, previously known as the Indian variant, which has risen in certain regions across the UK. I believe the medical experts are going to say that if it is delayed by a month, then they can vaccinate as enough people as possible. Of course, this has caused a lot of stress and dismay for those who are working in the hospitality sector, especially weddings. And we know that the delay was supposed to lift face masks, so you would no longer have to wear face masks anymore. Also, you could go to a nightclub. Nightclubs haven't been open for about 18 months, so their bosses are in despair. And of course, as well, weddings and funerals. At the moment, I believe there is a limit to about 30 people. It's changed so much. Please double check that. About 30 people. It was supposed to be limitless. That's not the case. A lot of people have been saying that weddings have been postponed or pushed back about 5 or 6 times. So a lot of people are not happy. There have been some people that say there will be a revolt, and that some individuals, particularly Sir Andrew Lloyd Webber, very known theatre operator here, he says, you know, come rain or shine, he will be opening his theatres on the 21st, and if they want to arrest him, then so be it. There is one newspaper, The Sun, who are reporting that it could be the 19th of July, though the concern from backbenchers and those who oppose this shift is that we've got to, you know, get on with living with COVID, that it will be impossible for rates to come down to a zero and remain that way forever, and that it's something we've got to get along with. But at the moment, this is all speculation, Laddie. We just have to wait and see what the Prime Minister says at 6.
All right, guess we'll wait and see. But the FTSE 100 index hit its highest level since February 2020, when the first wave of COVID-19 actually sent markets crashing. Who are the drivers and losers and the winners in this market?
Yeah, the FTSE is in good shape at intraday. It did, at one point in the day, hit those pre-pandemic highs. It's settled currently since, and this is all despite the fact that we will not be receiving Freedom Day on Monday. Travel-related stocks are weighing down the FTSE, so that's the BA owner IAG, Intercontinental Hotels, and the aero engine space maker Rolls-Royce. Their shares are all down. down. I think what's kind of lifting the FTSE are the oil majors. There seems to be sentiment drifting along the world that perhaps soon, as the world is starting to open up, then demand will outstrip supply, which is why we saw Shell lifting the blue chips and Tullow Oil and Kern Energy lifting the FTSE 250. So at intraday, the all share is up 0.48%. The FTSE 100 is up by 0.51%, and the FTSE 250 is up by 0.36%. In the currencies market, the British pound is down on the US dollar by 0.15%, down on the euro by 0.21%, and down on the Japanese yen by 0.16%.
All right, and anti-corruption watchdog says ministers could be banned from lobbying for up to 5 years after leaving office, and also face possible penalties if they break the rules. No doubt this is as a result of David Cameron's green seal scandal. But what are the rules here and that actually need to be adhered to?
Yeah, you're right. This is all down to David Cameron and that pretty embarrassing lobbying scandal with Greensill. There's still various investigations ongoing, but the Committee on Standards in Public Life is a government-backed kind of probing group who decided to do an emergency look into basically how this happened, because it's very important to note that David Cameron, the former Conservative Prime Minister, was actually exonerated from any wrongdoing. Of course, he's been left with a red face, but legally he did nothing wrong. And I think that's where lots needs to be done to find out exactly what, people who have a public life can do when they enter a private life. So the committee has recommended that there should be a ban on lobbying from ex-ministers for at least 5 years. That's the maximum. If they fail to stick within the rules, then they could be fined. No talk of any prison sentences or whatever. But, there are people who are on the other side of this argument who do believe that, of course, if you're a prime minister or a minister and you've left public office, you do need to make a living. How are you going to be able to do that? Because, of course, you're going to have all these internal secrets and you are going to have a wealth of contacts. So it's part of a wider discussion, but very interesting to note the main headline from this story is that 5 years for a ban for any lobbying of ex-prime ministers once they leave office.
All right, Juliana, thank you so much. We'll keep tracking that story. Do enjoy the rest of your day.
Thank you.
All right, shares in Asia Pacific were mixed Monday trade with multiple major markets in the region closed for holidays. The Nikkei 225 in Japan rose 0.74% to close at 29,161 points, while the Topix index gained 0.29% to finish its trading day at 1,959.75 points. South Korea's Kospi closed fractionally higher at 3,252 points. Markets in Australia, mainland China, and Hong Kong were closed for the holidays. And U.S. stock futures were steady in early morning trading Monday as investors digested the S&P 500's record level heading to a week with a key Federal Reserve meeting. Dow futures rose 17 points. S&P 500 futures and NASDAQ 100 futures both traded a fractionally positive territory. The Fed's two-day policy meeting will likely dominate investor behavior this week. Although the central bank is not expected to take any action, its forecast for interest rates, inflation, and economy could move the markets. Fed Chairman Jerome Powell speaks to the press after the central bank issues his statement at 2 p.m. Eastern African time on Wednesday, and he is expected to affirm the Fed's commitment to easy policy. However, concerns over inflation and how the Fed would react is likely to influence market direction, especially after a hotter than expected consumer inflation reading for May was reported last Thursday. And oil prices held near multi-year highs in early trade today, underpinned by an improved outlook for demand as increased COVID-19 vaccinations help lift travel curbs. Brent crude future was up 14 cents at $72.83 a barrel. It rose 1.1% last week and hit the highest since May 2019 at $73.09 on Friday. U.S. West Texas Intermediate was also up 14 cents at $71.05 a barrel after reaching the highest since October 2018 at $71.24 on Friday and rising 1.9% on the week. International Energy Agency said in its monthly report on Friday that the Organization of Petroleum Exporting Countries and allies, known as OPEC Plus, need to increase outputs to meet recovering demand. The OPEC Plus group has been restraining production to support prices after the pandemic wiped out demand in 2020. And after the break, in just a moment, we look at stories from the African continent. Do stay with us. This is Business Incorporated. Welcome back. You're still watching Business Incorporated. Tanzania has launched a new gold refinery as its central bank plans to start buying the metal to diversify its reserves. The Mwanza Precious Metal Refinery Limited is able to process 480 kilograms of gold per day and plans to double the capacity in a few months. The nation's state mining corporation has a 25% stake in the project, while Dubai-based Rosella General Trading LLC and Singapore's Acme Consultant Engineers Pte Limited own the rest. Establishing the refinery is part of the government's plan to add value locally from its resources, and Tanzania vies with Mali as Africa's third largest gold producer. It also has an estimated 57 trillion cubic feet of natural gas reserves. And Kenya's Treasury Cabinet Secretary Ukur Yantani understated the actual amount Kenya will borrow to fund its budget by 609 billion shillings as the government continues to paint a conservative picture of the debt nightmare it faces. As he reads the 2021-2022 financial year budget on Thursday, Mr. Yantani only provided details of how Kenya would generate the money required to fund the 88% of the 3.6 trillion shilling plan. The government, no doubt, is under pressure to cut its budget deficit. And so what are the areas of spending that can the government actually prioritize, and how will this affect businesses? Matt Kindiger, Associate Practice Lead Sub-Saharan Africa at Frontier View, joins us now to help us make sense of this. Hello, Matt. Great to have you.
Hi, good afternoon. Thanks for having me on the show today.
Good afternoon. So what does this budget reveal about the state of Kenya's public finances?
Yes, so overall the budget has revealed that public finances are, while they're not great, they're not quite as bad as we previously expected them to be. And this has really been demonstrated by the fact that the government has been able to postpone implementing the most painful fiscal consolidation measures that we were previously expecting to be announced. For example, we've seen in countries like South Africa where the government is planning to cut spending significantly. This has really been largely avoided in Kenya. However, it doesn't mean that public finances are particularly strong. The budget deficit is still expected to be about 7.5% of GDP over the next year. And the government it's assuming that it's going to be able to raise its tax receipts, its fiscal receipts by more than 10% this year. So that's a very bold assumption that it's making. And it expects this to be driven by stronger tax collection measures as well as overall higher rates of economic growth that will boost revenues. Very crucially, we are expecting the government to grow spending in real terms by the slowest rate since at least 2014. So, not terrible public finances, but certainly not particularly strong either.
Not strong. All right, but which industries will be the biggest winners and losers from the budget?
So it really depends on whether companies are selling to the public sector or not. So most companies that are exposed to government spending directly should expect to see relatively weak public sector demand over the next year or so. For example, government departments will see very tight procurement budgets. That said, most companies, in the private sector as well, are expected to see higher tax bills as the government tightens tax enforcement. But companies in the private sector could benefit to an extent from the current budget, and this is because the government has made it clear that it will continue to prioritize allocating funding to its Big Four agenda. So that includes companies that are exposed to manufacturing, especially food production, as well as those that are looking to grow their presence in residential and infrastructure construction, and additionally publicly funded healthcare. So those sectors of the economy, including in the private sector, will see higher levels of support from the budget over the next year or so.
And elections are on the horizon. How will this affect impact the government funding, actually their spending priorities come next year, August?
Certainly. So the election next year will have a big impact on government spending and tax priorities. The election next year is one of the reasons why we have not seen a very severe fiscal consolidation this year. We expect more, tighter fiscal consolidation to occur in late 2022 or early 2023. Part of the reason is because, one is that the government doesn't want to stifle the economic recovery, which would undermine job creation, especially in the private sector. But it also will be politically very difficult for the government to raise taxes significantly or cut spending dramatically. For example, civil service wages. The government wants to make sure that civil servants don't experience a lot of pain before the election. The government increased the value-added tax rate earlier this year. We don't expect that to be, things like that to be repeated again. But I would say companies exposed to the public sector, also most companies in Kenya, should expect, more significant consolidation towards the end of 2022 and beginning of 2023 after the election.
All right, Matt, we'll have to leave it there now. Thank you so much for your time on the program. Always great to talk to you.
Thanks very much.
All right, moving on. Ethiopia has called for expressions of interest for a minority stake in the state-controlled telecommunications company, starting the process of recruiting a second major investor into the country in less than a month. Investors have a month beginning today, June 15, to submit interest for 40% of Ethiopia's telecommunications core. The sale in Ethiopia Telecom, as the company is known, comes on the heels of a new telecommunications license awarded to a Safaricom PLC-led consortium last month, opening up the sector as part of the Prime Minister Abiy Ahmed's plan to attract more foreign capital and maintain one of the fastest economic growth rates in Africa and actually create more jobs. And South African President Cyril Ramaphosa says the agreement from the European countries at the G7 summit to enter text-based negotiations in the WTO on a waiver of COVID-19 vaccine intellectual property rights was a move in the right direction. India, South Africa, both guests at the G7 summit are leading the proposal to waive the intellectual property rights for COVID-19 vaccines at the World Trade Organization. The leaders at the summit also agreed to donate 1 billion COVID-19 vaccine doses over the next year to poorer countries, of which South Africa will be one of them.
What we have been able to get from, say, the European countries is the agreement that the World Trade Organization process must ensue, and there must be negotiations that are based on the text. And we'd like to believe that, having encountered negativity and opposition right at the beginning, the position has softened, it has become much more reasonable, and for them to have agreed that we should now have text-based negotiations, it represents a move which we would like to acknowledge. Now there's talk of making $100 billion available. Initially it was said to be $33 billion, and we've argued that it should be increased. We are still aiming for at least 25%, which could be in the range of $162 billion.
And that's Business Incorporated today. Thank you for watching. I'm Ladi Williams. From me and the team, it's bye for now.